Hello, Ria. Hi, Vanessa.
Hello.
There's Vanessa. I guess we'll get started in a minute or two here. Let me just get set up. Mm-mm-mm. Modules. Justin, how you doing? And Tasia. Okay. On Monday, we had our introduction to Cengage, and I went through chapter one. I'm going to go through chapter one again in a more truncated fashion. And then I'm going to go ahead to chapter two, if you want to stay with me. I'm going to go into chapter two. Some of you may want to get ahead of the game a little bit. And that's where it gets a little more interesting, I think. So let's start with chapter one for about 15 minutes, and then we'll get into a look at chapter two. So hold on. Oh, give me a second here. This thing doesn't like me today. Okay, can somebody verify that you can see the PowerPoint slides?
We can
Somebody
see
just
them.
said, you can see them?
Yeah.
All right, Ria, you're speaking up for the whole class then, okay? Let's go into chapter one, and that'll get us up to speed in terms of the schedule. But I am going to go a chapter ahead each class, I think, and try to get us caught up, because we've only got 6 weeks to go through the class. So let's have at it, okay? We talked about the purpose of accounting, huh? It's to provide financial information to individuals, agencies, and organizations, investors, creditors, potential buyers of a company, even potential employees, potential business partners. No one's going to sell you anything on credit unless they see what your financial statements look like. So quite important accounting, the language of business, they call it. Accounting is the language of business. And we talked a little bit about owners, managers, creditors, and government agencies. These are the types of people who need this information. Owners always need to know what the current financial position is of the company. They need to know whether they're in a position to expand or add a product line or some big investment. They may not know all the details of what's going on operationally. That's for the managers. So the managers of the place are the ones who are involved with the detailed measures of the business. For example, a sales manager, he may get a 10% commission on all sales over a certain amount. So he's certainly interested in what's going on. Your production manager, he or she may get a bonus of some kind based on a financial metric. Creditors, creditor is a lender. Creditor is a bank. No one's going to loan you money, like we just said, without financial statements. And the pesky IRS, they certainly want to know if you're paying your income taxes on time, huh? The accounting process, we gather information and we report it, huh? And these are the 6 steps. And I would like you to get familiar with this slide here. because like Cornelia mentioned in Monday's class, these questions are coming off the test bank, and they like to throw a few of these steps in. So you're analyzing things. Something as easy as, like I said, Monday, the electric bill comes, you look at it, you compare it to prior months, it looks reasonable, you've analyzed it. Now you record it into your financial system with a journal entry, and you classify it into the right area. You summarize, and then you report the results at month end. And then where the accountant's work often begins is after you're done closing, interpreting what just happened and trying to get some anticipation for the future. Two acronyms I'd like you to understand: GAAP, Generally Accepted Accounting Principles, and FASB, Financial Accounting Standards Board. GAAP, the Generally Accepted Accounting Principles, rules to follow when preparing financial statements, developed by the FASB, Financial Accounting Standards Board, which is a part of the American Institute of Certified Public Accountants. And they're the ones who develop the rules. When can you record a revenue? When do you record an expense? Is this a proper way to do something? So GAAP rules, GAAP, Generally Accepted Accounting Principles. And what FASB does is they look for, they're always looking at the world, what's changing. The world is always changing. And there might be some changes that need to be made. My favorite example from Monday was not credit cards, but gift cards at Costco. It used to be Costco would sell those gift cards and they would record that as revenue, and they were happy as can be. But now they realize that not everybody uses the gift cards. They'll just disappear forever. You've heard of that happening. So businesses now, under a new GAAP rule, have to anticipate that and record an appropriate charge. Three types of ownerships: sole proprietorship, partnership, corporation. Sole proprietorship, the most prolific of our businesses in this country. Owner assumes all risk, all rewards. If you invest in a business with $1,000 and you manage to lose $100,000 at the end of the year, you are personally responsible for that $100,000. So there's no corporate shield, there's no protection with the sole proprietor. You're willing to take the risk of starting a business in the hopes of reaping the rewards. Partnerships, two or more people running a business. One of the problems might be they disagree on how to run the business. They get to all kinds of disputes. The partners share the risk and rewards. And again, there is no limitation of your liability. Partnership loses $1 million. That's personal. That's got to come right out of the bank accounts of the partners. Corporation. This is you and me. We buy stocks in company. We buy 100 shares of Coca-Cola. We own Coca-Cola. We own it. We're stockholders. If Coca-Cola, God forbid, went out of business and they were millions and millions of dollars in debt, the creditors can't come after you as a stockholder. That's due to the corporate shield. If a business fails, that's not a criminal act, and there's no personal responsibility. Of course, an exception would be for fraud or some kind of malfeasance, criminal behavior. That's a whole different story. See Enron one day. We'll talk about Enron. Different types of business activities, service businesses, merchandisers, manufacturers. 110, 230, 240. And here in 110, we're going to be starting off with a service type business. A guy delivers pizzas and things. Service businesses, there is no physical product. You are simply providing a service for somebody. Travel agent, a lawyer, a doctor, computer consultant, etc. Merchandising. Merchandise means inventory. Inventory means the goods that you buy and sell, and you buy a product from one company, and then you hope to sell it to customers at a profit. Department stores, pharmacies, grocery store. You're buying a product and reselling it. You are the retailer buying from the wholesaler, selling to the end user who pays the sales tax. And then manufacturing businesses. We're not going to get into that at all with this course, but businesses that actually physically make the product they're selling. General Motors, IKEA, toy factories, Mattel. And then they talked about these different types of jobs in accounting. Accounting clerks. You can become an accounting clerk without any real experience. And it's a good way to get your foot into a company, though. You might specialize as a clerk in accounts receivable, accounts payable, and involved with a small part of the business. You're doing filing and recording information. Bookkeepers, they will supervise the accounting clerks, and they typically have a couple of years of accounting education. Para accountants, I never even heard of para accountants. I assume they're like paralegals. Accountants, huh? They're the ones who design the accounting information system. They focus on interpreting the data. They look for trends in the data. They study the impact of alternative decisions. And typically you need a college degree, at least an AS, hopefully, to get you started, huh? But yeah, that's when the accounting work begins. When the month is ended and they're looking toward the future and you're doing some budgeting and forecasting. And 3 areas of accounting careers: public, private, governmental. Public. These are your auditors. This is Ernst & Young. These are the external auditors that you hire to audit your financial statements. They're going to come in and they're going to look at everything regarding your financial statements, and they'll pass judgment as to the reasonableness of it. What you want to get at your public accounting people is a non-qualified opinion. It means they found no irregularities. Public accounting, those are the auditors that come through. Private accounting is you and me, or you and me. We walk down the street on State Street. We walk into a business, say, hey, are you hiring an accountant? And they say, yeah, come on in. Private accounting. These are the people who do everything: information services, cost accounting, tax accounting, budgeting. Internal auditors. Companies have internal auditors who are not allowed to pass judgment on the company, but they provide a very good service by making sure they're doing things correctly. Controller, principal accounting officer of the company, and you could become a CMA, certified managerial accountant. That's a certificate with heavy emphasis on what we call cost accounting. Or a CIA. You join the CIA, you become a SPI, a certified internal auditor. And then you have governmental and nonprofit. And like I said, Monday, we've got a ton of these types of places in the Santa Barbara area. So there's tremendous opportunities all over the place. I worked at the Santa Barbara neighborhood clinics for about 5 years. And that was a nonprofit. And it was just wonderful to see what that organization does for the community. And here they talk about job demand, accounting clerks, and they go through some supposed annual pay rates. And they're saying here, an accounting clerk, 37,000. I'm not sure how true these are. Bookkeeper, 41. Budget analyst, that's a nice job, 55,000. I used to love doing the budgets where I worked at the factories, putting together the whole format. Accounts payable manager, hey, he pays $83,000. That's not so bad. And a good accounts payable manager can save a company a lot of money by having good relationships with the vendors, by stretching out the payments without getting cut off. And the top audit executive, the controller. And that is the entire chapter 1. So you can see why it's just a real tiny brief introduction. So with that in mind, I'm going to zip over to chapter 2 and let's look at some transactions, huh? So please give me a moment here. Give me a moment. Chapter 2.
Professor, I have a quick question while you're looking
Sure.
for that. For when we were talking about types of businesses, would like Etsy or like eBay, the types of businesses online that sell products that people put on there, would those be service businesses because they're
Yeah,
not like purchasing? Okay.
yeah. They're not really selling the product. They're third parties, right?
Yeah.
Yeah, they set up a platform where I can sell my book collection to you. Yeah,
Mhm.
yeah. That I
Okay,
think it
got it.
definitely would come under the heading of service. They're
Okay,
servicing for
thank you.
merchandise companies.
Perfect.
Let's see what we got here. Give me one moment here. You're all welcome to join me today at 5 o'clock. Cornelia set this thing up where she would like to have a couple of students come in, have a sandwich with us, and just say hello and hang out. I don't know if anybody's going to show up, but the offer is out there. Okay, there we go. Come on, share screen. All right, Rhea, do you see it?
Yes.
Okay, all right. Let's have some fun now. Let's start learning about some transactions. Transactions. The accounting elements. Ooh. A business entity is just an organization that engages in economic activities and controls certain resources. That's a fancy definition, I guess, for a company. The business entity's finances are kept separate from the owners, and you'll understand that in a few minutes here. Sometimes the owner of a small business will mix his personal business in with the company, and it's careful that you keep them separate. Here is an accounting concept called the business entity concept. The owner of a business may have business and non-business assets. Non-business assets must be kept separate. And if the owner invests money into the business, other money, that is now business asset. Okay. We're going to learn about something in a moment called the accounting equation. We're going to talk about assets. Assets. These are items owned by a business that will provide future benefits. In other words, anything of value that the company owns, we're going to call an asset, and it's going to be classified as an asset. Don't have to be paid off. We might have just bought a giant machine and we're going to be paying the manufacturer for the next 10 years. We own that machine. Cash is an example of an asset. Merchandise or inventory, furniture, fixtures, the lights up above you, machinery, buildings, land, and accounts receivable, which you're going to hear about for the rest of your accounting world, huh? Assets, anything of value owned by the company. Accounts receivable is one of the assets. It's the amount of money that your customers owe you at that point in time as a result of making sales on credit. You know, companies typically don't run around with safes filled with money. You know, they trust each other to pay the bills. Everything's done on credit. So I sell you a product and the deal is you pay me in 30 days. That is my asset called accounts receivable. I have pretty good reason to think you're going to pay me in 30 days. That's my accounts receivable. To you, it's your accounts payable. We'll get into that when we talk about liabilities. Liabilities. A liability is a debt. It's an amount you owe to somebody. These are debts or obligations of the business that you're going to be paying off. And a lot of them have the word payable in them. Accounts payable, notes payable. And when you're doing these basic problems to get started, try to differentiate between what accounts receivable is and what accounts payable is. Accounts receivable, money owed to you that you'll be receiving. Accounts payable, money we're going to be paying to our vendors. So we have assets, liabilities, and here's the reciprocal of accounts receivable. Accounts payable. An unwritten promise to pay a supplier for assets purchased. purchasing on account or on credit. Whenever you see a problem and it says purchased on account, get in the habit of saying to yourself, on account of nobody had money, because there's no cash involved in that entry. It's going to be an increase in the payable and the receivable, and it's going to be an increase in a sale or a purchase. Don't confuse accounts receivable or accounts payable. Accounts payable represents the amount of money that you owe to your normal business associates, the electric company, the insurance company, the people from whom you buy your merchandise, the supplies. That's called accounts payable. There's no interest involved. There's no written contract. It's all done on faith. And that's how the world works. Notes payable is different. Notes payable is a formal written promise to pay. It has with it certain legal obligations. It has an interest rate. It has a date where the note is due, and is a totally different instrument than accounts payable. Notes payable, typically a borrowing situation, huh? And then we had assets, liabilities, and now we got a third category, owner's equity, the amount by which the assets exceed the liabilities, called net worth, called capital, could be called stockholders' equity. And that sentence there is meaningful. Amount by which the business assets exceed the business liabilities. I have a business and I've got $1 million in the bank. What if I said to you, I'll sell you that my company for $100,000? Well, you wouldn't do it until you found out how many liabilities I had. If I had $1 million in liabilities as well, my company would be zero net worth. Construct the accounting equation. Say hello to the accounting equation, which you need to know like your own name. Assets equal liabilities plus owner's equity, huh? Assets equal liabilities plus owner's equity. Assets, those are the items we own that are of value, cash, accounts receivable, or our favorites. Liabilities, the amount we owe. Owner's equity, the difference. We have $1,000 in assets. We have $200 in liability. We have a company on paper that's valued at $800. And interestingly enough, you're going to learn that $800 might not have anything at all to do with what the company is really worth. And we're going to be talking about that in the future. Here we go. A business has total assets of $60,400, total liabilities of $5,400. What's the owner's equity? What's the owner's equity? Assets $60,400 minus the liabilities equals owner's equity. The accounting equation must always remain in balance. As you go out into the working world, I don't think you'll ever have the accounting equation go out of balance, because no electronic system will let you post an out of balance transaction. Back in the old days, many years ago, we did this in pencil, and you can make a mistake and go out of balance and be a disaster. Let's look at some business transactions now. Let's get a feel for what we're talking about. A business transaction, an economic event, has direct impact on the business, requires an exchange with an outside entity, and you can measure it in dollars. All business transactions affect the accounting equation through specific accounts. Specific accounts. Cash is a specific account. Accounts receivable, inventory, accounts payable. An account, a separate record used to summarize changes in each asset, liability, and equity. Think of cash as a folder. Accounts receivable as a folder. You're putting in the increases, the decreases, and maintaining the balance. So here's the way they like you to try to think your way through some of these things. 3 questions. What happened? Make sure you understand the event that's taking place. If you can't speak about it in a quick sentence or two, then you may need to do more research. So what happened? What accounts are affected? Are they assets, liabilities, owner's equity? And how is the accounting equation affected? Determine which accounts have increased, decreased, and the accounting equation must remain in balance. 3 questions. My favorite example is a simple one. We got that electric bill in the mail. What happened? We got the electric bill is what happened. And the electric bill is a reasonable $1,000. What accounts are affected? You're going to learn that's going to be called electricity expense and probably accounts payable. We're going to pay it later. Show the effects of business transactions on the accounting equation. Mitchell's campus delivery. This guy delivers pizzas to City College and UCSB, I believe, and perhaps my apartment. Huh? First transaction, investment by owner. Mitch Williams just started a business. What happened? He took $5,000 of his own money and deposited into a new bank account in the company's name. Okay? So he has a business now with one asset, and that one asset is cash. He has no liabilities to begin with, so the capital is going to be affected. Cash is an asset. Capital is equity. So let's think about this. Which accounts have increased or decreased? Cash went up, and so did the capital. Does the accounting equation balance? Oh, yeah. Assets, 5,000 equals 0 plus 5,000. So that's just a quick entry to get us started with a new business. And here they're showing you the accounting equation. And as we go through these transactions, they'll spread them out a little bit. So you can see that right now, $5,000 equals $5,000. All right. Well, he put the money in the bank, but he's got to use it to do something, huh? So he bought delivery equipment for $2,000 in cash. What happened? He bought some motor scooters or something. What is affected? Well, they're saying that he paid with cash already, huh? So we know cash is involved, and he bought delivery equipment. We're going to call delivery equipment another account, just like cash is an account, just like accounts receivable. We're going to set one up called delivery equipment, and we're going to keep track of that folder. Classify these as assets or liabilities. Hey, they're both assets, huh? Cash is an asset, so is delivery equipment. So what happened here? Cash decreased, but the delivery equipment increased. In other words, it was just an exchange of assets. He traded one asset for another. He gave up cash for some delivery equipment. And now you look at your accounting equation. We still have 5,000 in assets, but we don't have 5,000 in cash anymore. That's gone down to $3,000, and that's offset by the increase in the delivery equipment. Purchase an asset on account. On account. What did I tell you? On account, and nobody had money. So as soon as you see on account, you know it's probably going to be accounts payable or accounts receivable. So we bought the equipment. Bought the equipment. Guess what? We're going to have to pay for that equipment in the future. This is accounts payable. So Mitch bought delivery equipment on account. Payments will be made over the next 3 months. No cash. What accounts are impacted? Delivery equipment went up, and so did accounts payable. One's an asset, one's a liability. So let's take a look at our growing accounting equation. Assets total 6,800. We now have a lot of delivery equipment. We owe $1,800 plus the 5,000 is 6,800 in balance. He is going to pay back some of that money. It says payment on a loan. It should say accounts payable, I think. But Mitch paid the first installment on the scooter of $600. So what's going to happen here? Cash is going to be impacted. We know cash is going to be hit, and accounts payable. Cash is going to go down because we're now paying for it. And the amount we owe, otherwise known as accounts payable, that's going to go down as well. Which accounts have increased or decreased? Cash decreases, accounts payable decreases. Cash is an asset. Accounts payable is a liability. As soon as you see the word payable, you know it's a liability. And here we go. Look at the cash now. He paid 600. His cash total is down to 2,400, but his accounts payable is down to 1,200. He doesn't owe 1,800 anymore. And jump in with any questions, or if I'm going too fast, or you want to, make a comment. Okay, we talked about assets equal liabilities plus equity. Let's talk now what affects equity. Revenue. Whenever you have revenue or a sale, sales and revenues mean the same thing. Whenever you have a sale, you have increased the equity of the business, okay? Revenues increase the equity of the business. And revenues are recognized when they're earned, even if the cash has not been received. So don't get into the habit of chasing the cash. That's gonna lead you up or down a rabbit hole. We recognize revenue when you make the sale. Today is May 18th, I think. Today we shipped out $100,000 worth of auto parts to our customer back in New Jersey. Well, he's going to pay us in 2 months is the deal. But when did we sell the stuff? We sold it today, May. That is a May transaction for the revenue. And revenues will increase in asset known as equity. And we've got different types of revenues. There's a million of them. In our world here in 110, we're talking delivery fees, consulting fees, rent, maybe some interest to accrue, sales. The opposite of a revenue is an expense, huh? Expense represents the difference in assets as a result of efforts made to produce revenue. I would cross that sentence off. That's jargon. Separate accounts are maintained for each type of expense. What are some of the expenses? Well, you know them in your own life. Rent expense, supplies expense, tax expense, salaries expense, insurance expense, depreciation, there's all kinds of them. Expenses. Revenue minus expenses equals your net income. And here's a concept of accounting from GAAP. The concept that you can take a business and decide to analyze it with financial statements on a period basis. In other words, most companies prepare financial statements every month. The concept is that a business can be broken down into finite amounts of time, periods of time for analysis. Now, you didn't have to come to City College to understand this graph, huh? If your revenues 9,000 or higher than expenses, you made money. You have net income. If your revenues are 3 and your expenses are 5, you lost $2,000. Net income, net loss. Now, here's where we were talking about the personal mix of business. Small business, withdrawals. That's another account. It's an equity account, and it's going to reduce your equity. The owner takes cash or other assets from the business for personal use. When that happens, you have to reduce the value of the business. He took an asset away. That's going to reduce the net worth of the business. And these withdrawals can be called drawing. You're sitting at your desk, the accounting guy, and the boss comes out and says, cut me a check for $2,000 payable to me. And you say, yeah, boss, no problem. What's it for? You need to know what it's for so you can put it into the system. And he said, well, I'm taking my wife to Las Vegas for a week. Well, you know that's a personal junket. And you would record that as a withdrawal, not as an expense. So let's take a look here at our elongated formula. The equation starts with assets of 6,200 equaling 6,200 here. 1,200 in payable after we paid that first payment of 600 plus the capital. As the month goes on, we're going to record revenue and we're going to record expenses. And at the end of the month, we're going to add up those revenues and we're going to subtract the expenses and see if we made money. If we made money, that profit will then roll its way into capital and increase the equity. Okay, so let's do some income statement type transactions. Mitch, what did Mitch do here? He received $2,100 from clients for delivery service. Okay, he went out and he delivered his pizzas all over town. He now has $2,100 in his pocket he didn't have. That's cash. And that's a cash that increased. And guess what? That's a sale and that's going to increase the owner's equity. So let's take a look at this. Cash increased by $2,100 and so did the sale or revenue. No impact on liabilities. So let's take a look what we have here. We have $8,300 now that we add in this $2,100 of cash and $2,100 of revenues. So far your revenue, your equity now consists of the original investment of $5,000, no drawings yet, plus the sale of $2,100. Uh-oh, paid the rent, can't get away from that. Well, we paid it. As soon as you see the word paid, you know it's cash. You know it's cash. So cash went down, sadly, and rent expense went up. Cash went down. Let's take a look at how that hits in here. Take a look at the right here. There's your first expense, $1,000. Okay. So your equity consists of the beginning 5, plus your revenues minus the expenses. The revenues right now are $2,100, expenses are $1,000. If this was the end of the month, this guy would have a profit of $1,100 and equity would go up. Equity would go up. Paid the phone bill. So you see the word paid, you know, cash is coming down. Paid the phone bill, got to record that expense. And here we go. There's another expense, phone expense, $100. That reduced the equity. It says plus here, but that's because we're going to minus these pluses out. The expenses went up, which reduces your equity, and the cash went down by the same amount. Ooh, here's a good one. Delivery revenues earned on account. Remember, we said if it's on account, it's probably going to be accounts payable or accounts receivable. What happened? Mitch he delivered more pizzas for $2,400. They had a big party at UCSB. He catered it with pizza, $2,400, and the deal is they're going to pay him next month. So cash is not touched yet. And since he's the one who's going to be receiving the money, that's his accounts receivable. So that asset went up. Accounts receivable. And the reason that asset went up was he had a sale. So your equity is going to go up through another income account called delivery fees. And here you see it starting to flesh out a little bit, huh? Now he's got $4,500 in revenues and $1,100. Revenue is recognized when it's earned, even though the cash is not received yet, okay? He bought supplies. He went out and bought supplies. And these supplies are going to be lasting for a couple of months. Because he's not going to be using them right away, class, we're not going to call it an expense. We're going to call it an asset. These are supplies that he prepaid. That's an asset called supplies. The cash goes down, this other asset goes up. So we've added another asset called supplies. When he uses the supplies is when we record supplies expense, okay? Right now it's an asset. We haven't used it yet. Here we go. Remember, he just did a transaction. He sold what, $2,400 on account. Now it's a month later, perhaps, and he received $1,900 in cash. Well, he's already recorded the revenue, right? He recorded the revenue. Now he's going to reap the rewards of that sale. So he is going to receive the cash, 1,900. That asset goes up and accounts receivable goes down because the customer no longer owes us the $1,900. And here we go. We threw in accounts receivable here. Everything is still in balance. Oh, here's our first 3-line entry, huh? Any entry that has more than 2 lines is called a compound entry, by the way. Purchase of an asset on account. Again, the words on account are there. So we know it's going to be accounts payable or accounts receivable. Let's figure out what happened. He bought a scooter for $1,000. He put $300 down in cash, and he agrees to pay the rest over the next 4 months. Well, that's pretty clear. We bought a scooter that we're going to have to pay for later. Accounts payable. So accounts payable is going to go up. Cash is going to go down for the 300, and the equipment's going to go up for the 1,000. And that's what they're showing you here. Cash goes down by 300. Accounts payable goes up by 7. And the total is the value of that asset. And there you have it. This guy's buying a lot of equipment, huh? So we're still in sync here. Uh-oh, you got to pay the insurance, $700. By definition, when you buy an insurance policy, it's an asset, okay? It doesn't become an expense until you get the benefit of the policy. In other words, you bought a comprehensive policy in December of 2021 that covers you for 2022. Well, if your business burned down in 2021, you have no insurance. The insurance doesn't kick in until the month of January. At the end of January, you'll recognize an expense of 1 month's worth of insurance. So let's see what we have here. We are going to pay $700. Cash is going down, and prepaid insurance is going to go up. Prepaid insurance. In Chapter 5, we're going to have a lot of fun with the prepaids. Both supplies and insurance are recorded as assets because they'll provide benefits for several months. In other words, you don't record the expense until you actually consume the item. He has to pay the people delivering the pizza. And here we go. He paid $16.50 in wages. Okay, so that's what happened. Well, cash is involved. He paid him in cash, I'm sure. And that's an expense. Wages are an expense. So your expense went up by $16.50 and your cash went down. No impact on liabilities. Ooh, we added another expense here. How about that? Deliveries made for cash and on account. This is the reciprocal of the problem we did a few slides back. Here, we delivered something for cash and on account. So let's try to understand what happened. Deliveries of 3,500 were made. 900 were made for cash, 2,600 on account. We made the sale. We delivered these pizzas. We're going to be paid that 2,600 in the future. That is accounts receivable. So you have 3 entries here, 3 line items. You've got the cash increasing by 900. We like that. Accounts receivable up by $2,600. The total sale was $3,500. That increases the owner's equity. And you can see that we're still in balance here, okay? And I think this is the last transaction before we get into a little more work. Withdrawal of cash. Now, here's the personal business of the company. Mitch took $3,000 out of the business for personal reasons. He came to you and said, cut me a check for $3,000, please. And when you asked him what it was for, he said he's going to Santa Anita. get some bets down. That's personal. That is going to decrease the equity of the business. This business is now worth $3,000 less than it did before he took this money out. So our cash is going to go down and our equity is going to go down in the form of this drawing account. So let's take a look at the drawing up here. Here's the cash coming out. Here is your equity, $5,000 plus $8,000 for revenue, minus $2,750 minus the drawing. Capital beginning balance minus the drawing plus revenues minus expenses. Okay. Withdrawals by the owner are reported in the drawing account. A withdrawal is not an expense. Students make that mistake a lot. Withdrawals are not an expense. There's no impact at all on the company, except to reduce the net worth. Just like expenses, the drawing account will increase, but it causes a decrease in owner's equity. Hey, let's look at our first financial statements, huh? And then we'll get out of here in a few minutes. You ready? Prepare and describe the purposes of a simple income statement, statement of owner's equity, and balance sheet. These are the three basic financial statements that all businesses put out. They have to be done in a certain format, under certain GAAP rules, and they must be done in this sequence. You must do the income statement first, followed by the statement of equity, followed by the balance sheet. And as we go through the first couple of weeks, you'll understand why. Hey, you may understand why when we get done here in a few minutes, huh? Financial statements. And they have a certain heading. You put the name of the company, the Santa Barbara College income statement for the month of, and here it is here, an example, Mitchell's Campus Delivery. And the heading is important, obviously. I'm not even going to look at this page here. They're giving you tips on when to use double lines and dollar signs. You have my permission to ignore that. Hey, look at our income statement. Wow. He had sales of $8,000. And remember the expenses he had? He had expenses of $1,650, $1,000 for rent, wages were $1,650, and the phone was $100. Total expenses were $2,750. Subtract that from $8,000. This guy made a tremendous profit of $5,250. He made $5,250 on sales of $8,000. That's about 60%, huh? It's over 60%. That's pretty darn good. Where did we get these numbers? Where did we get that 8,000? Where did we get the 1,650? You know where we got them. He came right from here. Here is your 8,000. Here is your 2,750. 8,000 minus 2,750 equals your net income. That's all an income statement is. Revenues or sales minus your expenses. Now, of course, as we go along, you'll see big income statements with different categories and things like that. But this is the poor man's look at an income statement, okay? I said we had to do the income statement first. Here's why. We came up with the net income. Now we have to update the owner's equity. We don't update the equity every time you make a sale, every time you make an expense. That would be a waste of time. We do it only at the end of the month when we add up the revenues and expenses. So we have to take the beginning equity and adjust it. Statement of equity reports the activities that affected the equity, and it uses the income from the income statement. That's why it must be done first. So take a peek here. Maybe see that a little better. We had no business at all until Mitchell put $5,000 into a business. So his beginning balance was $5,000. We go back up to our prior slide and take that income of $52.50. We're going to add that. He did take $3,000 out though. That withdrawal reduces the net equity. So overall, he grew his business. He took a $5,000 business and he turned it into a $7,250 business, huh? Again, that's pretty darn good. He grew the business 50%. That's not so bad. Your equity statement, don't be scared by this. It's simply the beginning investment. I'm sorry. It's the beginning investment plus net income minus withdrawals to the ending equity. That's all it is, just 4 lines. Again, students get a little rattled by that for some reason. Now let's look at the balance sheet. The balance sheet. This one has to be done last because we have to get the new equity number. And that new equity number was $72.50. So look at the balance sheet. The balance sheet is the accounting equation. The balance sheet is a presentation of the accounting equation. You have total assets on one side, and then you have your liabilities plus your equity. So here we've got total assets of $91.50, which agree with the $91.50 on this side. Where did we get the cash number? $470. Where did we get that $3,100? Right here, from all the work we did this month. $470, $3,100, $80, $700. Here we go. So those are the 3 basic financial statements, and you'll do a lot of homework with these, I think. 3 basic phases of the accounting process. Just this often pops up on the test in some form. Input, processing, output, the accounting process. Input, processing, output. This could be on the test and worth a point or two. And that takes us to the end of today's presentation. Anybody have questions, comments? Everybody quiet?
I have a question about the notes.
No, go for it.
So in one space it said 3 pages of notes, and then I think an email went out that said 4 pages. Which is it?
Oh, you mean on the summary of the chapters,
Yeah,
right?
summary.
I thought you were doing notes payable.
Oh, sorry.
No, 3 pages, not 4.
3. Okay, thanks.
Yeah. Anybody else? Question? Comment? Anybody want to suggest we end the meeting?
Just a thank you, Bob. I appreciate it.
Okay, well, thank you. And we'll see you guys Friday, hopefully, okay? Or today at 5 o'clock on West Campus. I'm going to be out there with a couple of sandwiches for people who want to stop by, okay? Maybe see you later. Bye-bye.
Bye-bye.
Thank you.